with investors on their perspectives. And I'll invite Anne-Marie Chisero to lead us through that discussion, figuring out what are both the opportunities and challenges that the investor community sees.
Great, thank you very much.
Over to you, Anne-Marie.
Thank you, James. Thank you very much. I'm delighted to moderate this session on the investor perspective for financing green in Africa, and in particular, Kenya. We have a great group of executives who are in key decision-making positions that can influence the flow of capital to green in Africa. They include asset managers who make decisions on where to invest money, development banks and intermediaries that enable change in the financial market, the stock exchanges that allocate savings into investments, and finally, the managers that invest directly in green businesses. So let's dive right into the discussion, because I know each one of them have a lot to say, and we do have a few people to speak. So let me start with Steve Waygood. Steve, you are the Chief Responsible Officer for Aviva Investments, which is one of the UK's largest asset managers, managing £350 billion. Kenya is sub-Saharan Africa's third largest economy, and its GDP, $100 billion, puts this number into perspective. So you sit at the top of the funnel trying to find ways to channel capital through very thin pipes to green assets in Africa. What are the conduits for channeling this investment into a country like Kenya? And what are the smart capital structures needed to do this? Steve.
Thank you, Anne-Marie. And can I start by saying an enormous thanks to the organizers for this event for the very kind invitation. It's humbling to be here. Really enjoyed reading through all the preparatory information for this event. And just as Nigel Topping said, I've already learned so much from participating, and I hope to be able to share a few perspectives from the position of one of the world's biggest insurance companies. For those of you that don't know Aviva, we're a systemically important financial institution. You heard from Anne-Marie that we have a considerable amount of money under management, not just on our own book, but also on behalf of 33 million clients around the world. As a business, we've been around since 1696. So we've seen a lot of change over that duration. We're unusual because we're listed ourselves in the UK. We're also a very large asset owner. We're also a very large asset manager, and we can see the short-termism in the markets, the pressure that we're brought to bear, as well as the long-term change that we've witnessed in the parts per million of CO2 in the atmosphere and what that has done to global atmospheric temperature. The reason why we are so concerned as an insurer about climate change and why we need to see the whole topic of this debate globalized and an effective outcome to COP26, and we wish Nigel so much good fortune for that, is because as a business, our business is existentially threatened by climate change. At certain business as usual scenarios, by the end of the century, if we do hit roughly 3.5 to 4 degrees of change, we think that wipes out parts of our insurance business. And therefore, from a fiduciary duty perspective, we are deeply concerned about climate risk, not just because we should be worried as human beings for our children, but also because we're worried as executives because of our business. So that's the context from our perspective. I'm very pleased to be able to say that having worked now for Aviva for 15 years, on Monday, the biggest announcement I think over that 15 years took place. A colleague of mine, Sam White, coordinated the climate transition plan for Aviva. We've announced that we wish to become net zero by 2040, reducing by 60% our investment in emissions intensity by 2030, and reducing that emissions intensity by 25% by 2025. This means we've made a new commitment by 2022 of 10 billion in assets under management being allocated to green finance. We already have 6. So that gives you a flavor of the assets that we've got and the scale of our concern. Now, you asked me, Anne-Marie, about conduits. And I wanted to build on the intervention from Joshua, which I thought was fantastic. And Joshua mentioned how the KCB and other commercial banks like the nexus between countries and businesses like mine. And the one that I was really pleased to read that Kenya has the NDC financing strategy. It's a great document. I really enjoyed the analysis on energy, transport, food, and forestry. I also was very pleased to hear Peter Odengo from the National Treasury talk about the scale of a fiscal response, which will be crucial. We need to make sure we change the underlying fundamentals in the market. But the scale of the challenge that was introduced at the beginning, 7 trillion needed in Kenya to finance the NDC. It is unusual having a financing strategy for the NDC, so I want to give full credit to Kenya for creating that, and all of you who I'm sure were involved in building it. Now, from my perspective, the conduits include our sovereign investments, green or otherwise, into the country, or any country for that matter. Secondly, a lot of the development conversation focuses on foreign direct investment. That's where companies and other institutions, but companies particularly, invest inwardly into your economy. Now, we will often own and capitalize those companies. So don't just think about us as portfolio investors into the Nairobi exchange. Think of us also as how do we capitalize those companies doing FDI? And in particular, what do we ask them to do in terms of environmental and social safeguards, as well as how they make the returns that then pays the dividends that pays our clients. So how do we behave as stewards of those businesses? So that's the second conduit. Third, our own portfolio flows, portfolio investment into the Nairobi exchange, as well as the FDI. They've obviously been put under a great deal of pressure in recent years, and FDI has gone sideways, not north. So there's, you're well aware of that. And then the fourth and the fifth conduits would be our own infrastructure investments and our structured finance. And then to come to your question about what innovative mechanisms are needed, we're fans of blended finance. The last few years have seen our investments in that space escalate. And what we look for in detailed terms, we're looking at deal size between 50 and 150 million US dollars. We're looking at a term up to 15 years, or an average duration of about 15 years worth of investment. So it's very long term for us. We're obviously far less liquid than equities or corporate bonds. We also want to have assurance that those ESG safeguards, led by the World Bank, but now being implemented in your own region too, those ESG safeguards matter a lot to us, not just because of our brand, but also because we know ESG matters to long-term valuation. And we're also looking for investment grade after the insurance or guarantee has been applied, which is where the blended finance issue comes in. The reason why we need investment grade is that is what our clients instruct us to deliver in their mandates. So if I were Peter and I was looking to build out a next sustainable finance strategy, I'd look very closely at the high-level expert group in the European Commission and the Sustainable Finance Action Plan, because they actually go into more detail than the current Kenyan Sustainable Finance Strategy does in how do you transition finance so that it finances the transition. So I think that is missing, Anne-Marie. Now I have more to say, but I'm conscious of the time. Back to you.
No, thank you. I want to turn to Tim Turner, who used to be a VP at the African Development Bank and has also designed creative instruments to leverage the African Development's capital for investment in the real economy. But he's now with the Trade and Development Bank and is looking at creating a green class of listed shares. So this is an interesting way to place large investment capital in green, but it also ties TDB to a green investment strategy. So Tim, can you tell us a little bit more about the structure and why you are confident it's going to work? And then I'm going to ask Steve to comment on that as well. Tim? I know Tim is in the Ivory Coast.
Yeah, and thank you very much, Henry. And I hope my my network is working okay.
Good.
Is my network working okay? My connection?
Yeah. Yes, we hear you loud. Go ahead.
Very good. Good afternoon. Let me begin by thanking the organizers for the kind invitation to speak at this timely event. I'm really honored to be representing the Eastern and Southern African Trade and Development Bank, or TDB as we're commonly known, especially for a Climate Champions event focusing on Kenya, which of course is where TDB has its largest office. As we've heard today, climate change is a shared risk that nobody can afford to ignore. Acknowledging this risk, TDB is in the process of accelerating its transition toward becoming Eastern and Southern Africa's region's leading green bank. And we see a tremendous opportunity to create new pathways, or as Steve coined the phrase, conduits, to enable institutional investors from around the world to support Kenya's green growth story. But before I get into this, let me just give a little background on TDB for members of the audience who may not know us. TDB is a unique development finance institution. We were founded more than 35 years ago to serve the development needs of COMESA countries. TDB now has 22 member countries, including Kenya, and 18 institutional investors as shareholders. So TDB is really a hybrid bank with a core development focus, but also a clear commercial lens for choosing portfolios approaching $6 billion long-term financing for projects and infrastructure. To give you a flavor of TDB's green portfolio in Kenya, we're one of the financiers of the Turkana wind power project, and we're also working on a pipeline of geothermal projects in global financing to address climate change. A few weeks ago, Larry Fink, the CEO of BlackRock, which of course is one of the world's largest institutional organized by the OECD. He made a very interesting point. He said, the existential risk of the COVID pandemic has actually enlightened the existential risk of climate change to the health of the planet. He went on to say climate risk is investment risk, and in every industry, we're starting to see this reallocation of capital. If you believe Larry Fink, and obviously a lot of investors do, the binding constraint
so it looks like we're
for supporting climate change is not the available institutional investors to realize their investment ambitions. TDB is urgently working on a solution to address this problem. It's called listed green equity, which you referred to earlier, Anne-Marie. Can I continue?
Yeah, no, you're sort of coming in and out.
TDB is exploring the issuance of a new class of shares specifically designed to create a listed pathway. Let me turn the video off then, and we'll see if that helps. So TDB is exploring the issuance of a new class of shares specifically designed to create a listed pathway for impact investors around the globe to support our region's climate change ambitions. The capital raised through green shares would be leveraged 4 times and invested into green projects in our region. Most people have heard of green bonds, where the proceeds are invested dollar for dollar into green projects. However, green equity would give impact-focused investors $4 of green investments for every dollar of their capital. This would be the first green equity instrument of its kind, and TDB hopes to raise up to $500 million from impact investors over a number of years. Leveraged 4 times, this could represent as much as $2 billion of new TDB green investments in our region. To further enhance the appeal for institutional investors, TDB is looking at structuring the green class of shares as senior equity that is protected from first losses and benefits from preferential dividend rights. If historical trends continue, investors in green shares could earn an average return of about 12%, which is a very attractive commercial proposition. TDB is also exploring options to list the green shares on at least one international and one African stock exchange. I won't conceal the fact that we've had discussions with both the Nairobi and London stock exchanges as possible listing venues. In this regard, I'd like to thank Jeff Odundo, the CEO of the NSE, and Ibukun Adebayo of the LSE for their support. Listing of TDB green shares would add to the attractiveness for institutional investors in 3 main ways. First, by providing liquidity if they want to sell the shares. Second, by giving them transparency on pricing for valuation purposes. And third, by providing additional transparency on TDB's activities, which would be a regulatory requirement for listing. So to conclude, TDB has been working on this instrument for several months, consulting potential investors and tailoring the structure to meet their needs. The TDB's board will soon be asked to consider the final terms of green shares. We've also been reaching out to development partners such as the UK, Danish, and Canadian governments the Green Climate Fund, the Nordic Development Fund, and UNCDF to help us catalyze this game-changing new instrument. TDB recently proposed its green shares concept to compete for a slot of one of the UK government's flagship initiatives.
Tim, I'm going to stop you there because you've now gone out again.
Mobilist program that FCDO is running. If Green Shares is selected by Mobilist, then
Tim, thank you. This is really exciting news. I'm going to turn quickly to Steve. Would you invest?
Anything that helps with liquidity, transparency, and integrity in the market is very much to be welcomed. We'll obviously take a look. I think that we need to see this as one of hopefully hundreds of thousands of initiatives that financial institutions will take around the world to help mobilize the transition. And we can't invest in all hundreds of thousands of them, but we can certainly have a look.
Great. No, thank you, Steve.
Everyone should take initiative.
Great. Thank you, Steve and Tim. I'm going to switch now to Lasita Pereira, who is the CEO of Garantco that takes risk out of innovative infrastructure projects. The question is, are we always going to need institutions like Garantco, or can we expect the market to normalize such that investors are able to price risk accurately and build an appropriate premium into their demands? Lasita?
Thanks, Anne-Marie. And also, I'd just like to say thank you as well to FSD Africa for this opportunity to join the roundtable. To answer the question, I sincerely hope so. I'm very much looking forward to being made redundant as soon as possible. And but I would say that I think that it is possible as well, and we can demonstrate that. For example, the green bond, the first green bond that Kenya did, which was referred to earlier, was actually guaranteed by Garantco, the Aecon bond last year. And what we're seeing now is that Aecon is coming back to the market. It's come back to the market in the form of a REIT, and it's been able to attract institutional investors without any form of credit enhancement into that, albeit that Garantco is part of the private infrastructure development group, and our equity arm has also taken a position, Infraco Africa has also taken a position in that REIT. So we do create some level of halo effect, but not by providing a guarantee. The investors are actually taking naked risk. And it's really that ability of the guarantee to help build capacity amongst investors, which is quite the important thing. But it's also the beauty of the guarantee that, the investor says, we don't need it anymore, cancel it, it's gone, and the investor can be flying solo. So that's where we see the power of the guarantee coming into play. And, we're looking to do more in Kenya, and particularly in the renewable energy sector. One of the challenges we see is that it's been heavily funded historically by the DFI community, which is understandable because that should be the process in any new market where you have sort of donor capital coming in first to kind of de-risk the structures. But then fundamentally you get to the point where there's scale, and then really you need to bridge that transition from the public to the private sector. And again, that's where we see the role of the guarantor coming in and doing that. In Nigeria, what we decided to do was actually build a local guarantee company called InfraCredit Nigeria, alongside with the Sovereign Wealth Fund of Nigeria. InfraCredit Nigeria, over the last 3 years, has wrapped 3 or 4 energy bonds. But what happened last year was that 2 energy companies came into Nigeria and issued energy bonds with 0 credit enhancement. They were BBB rated, and the pension funds went in and they were like 25% oversubscribed. So that demonstrates the ability to transform the market. And really what we're hoping to do now as Garantco is to build an InfraCredit Kenya over the next couple of years to try and generate the same kind of market transformation. So I'm just going to leave it at there because I'm conscious of the time. But certainly we see that guarantees still have a role to play going forwards.
Great. No, thank you for that. I'm going to turn to Rianne Marie, who is the CEO of the Green Finance Institute. And your strapline says that you channel global finance into local solutions. if I'm not mistaken, that credit enhancement is the key to unlocking capital. Is that correct? Would you agree?
I certainly would.
Yeah.
Channeling, thank you very much, Anne-Marie, and to the organizers today. You know, the challenge here is to channel the trillions that we need into climate mitigation and adaptation, most notably in middle income and developing countries where that investment gap is so stark. And the OECD estimates the need for about 4 trillion per annum, whilst current flows are in the 60 to 80 billion range. And this seems particularly perverse given that record flows of capital into ESG aligned funds. During 2020, sustainable open-end and exchange-traded funds available to European investors attracted net inflows of over 230 billion euros. And that's almost double the figure for 2019. And to put that in perspective, in the fourth quarter alone, sustainable funds pulled close to 100 billion euros in net new money. That's 45% of overall European funds flow. And this momentum is set to continue with the MiFID directive in Europe, ensuring that all financial advisors have to ask investors what their sustainability preferences are. So we can only expect this to continue. So much of the discussion in financial centres like London has been around how we channel this wall of finance towards the real economy investments needed. And there's been real high hopes that blended finance structures using impact-based public funding to lower the perceived risks of emerging market investments through providing those first loss guarantees and hedging foreign exchange risk is going to provide the answer. But blended finance to date is really struggling to scale, and there's certainly scope to explore other potential solutions. At the Institute, we've been working with African investors and banks, notably in South Africa, and also with FSD Africa, to devise mechanisms that are focused on mobilizing the local domestic capital pools across Africa towards green investment in both mitigation and adaptation projects like energy generation, like waste and water management and desalination. And building on the great work of my former Barclays colleague, Lucita Pereira, good to see you, Lucita, at Garanco, we're developing the concept of a credit enhanced guarantee fund that would be funded by a combination of impact-based public funding and European institutional investors that supports the credit risk profile of African projects, enabling domestic investors to invest and develop the local green markets, which I think is becoming an increasing theme. If we look at Kenya, the total retirement benefits under management last year stood at over 1.3 trillion shillings, so that's over 8.6 billion pounds. And those assets have increased year on year. And the retirement funds invest very heavily into government securities. I think it's almost 45% of total assets under management. So the introduction of a CGF type facility focused on a very confined set of infrastructure objectives in order to maintain agility can really help to diversify their investments, especially given that it is entirely targeted on the concept of mobilizing domestic resources. And it's been really, really encouraging to be part of this conversation this morning and better understanding Kenya's very clear ambition to build a green infrastructure of the future. I will leave it there. I have specifically only spoken about investment in infrastructure, Anne-Marie, but I'm delighted to see that there is a panel later that's going to talk about natural capital, which is again a huge focus for us at the Green Finance Institute, as it will be for many others, I think, over the coming years. Thank you very much.
Great, thank you, Anne-Marie. I'm going to shift gears a little bit, and you talked about local capital, local savings. I'm going to ask Siobhan Cleary, you're a board member at the Johannesburg Stock Exchange. What can Kenya learn from South Africa's experience, good or bad, in building a market for institutional investors interested in sustainable investing?
Thanks, Anne-Marie, and thank you so much to the organizers for inviting me to be part of today's session. Just to say, I am fully conscious that despite the fact that South Africa and Kenya are on the same continent, we have different histories and different experiences. So I share these reflections as reflections, not necessarily Kenya would necessarily have to deal with the same types of issues or approach them in the same way. But before I sort of get into some of the sort of lessons learned in our market, some of which are hopefully applicable in Kenya, let me take a step back and provide some context on South Africa and particularly Johannesburg Stock Exchange's experience, with sustainable investment and investing. So we launched our formal green bond market in 2017, but our exchange's focus on sustainability goes back to 2005, when we launched what at that time was the first exchange run and operate sustainability index. Interestingly, at the time, we didn't have a problem getting companies to participate because the idea of a social contract was well established in South Africa. But what we did struggle with was getting investors on board. Despite the fact that South Africa had significant social and environmental challenges, we really battled to convince them of the investment case for sustainable business conduct. And some of you have heard this, but I even had one large investor tell me at the time that sustainability amounted to theft from shareholders. So this was despite the fact that the UN Principles for Responsible Investment had been established in 2006. And actually the South African Government Employee Pension Fund was one of the first signatories to the PRI. Unfortunately, we found that the mainstream private institutional investors remained less convinced of the proposition. Despite this, we pressed on as the exchange. We became a founding member of the Sustainable Stock Exchanges Initiative, which I know Steve was integral in setting up. And as I mentioned, we established our own green bond segment in 2017. Since the launch of that segment, we've expanded the platform to include a framework for social and sustainability bonds, and are now looking at sustainability linked bonds and in a transition framework, a framework for transition finance. One of the things we've noted is that despite the fact that I think South African institutional investors are still, some of them in any event, are still lagging a bit in relation to broader consideration of sustainability factors when it comes to at least equity investment, green bonds have been very well received in the market. We currently have 12 bonds listed from 5 issuers. The market sizes are slightly over 9 billion Rand, and though that's of a market size of approximately 3 trillion Rand. But it's not inconsequential. And all of the issues that have happened, or at least the ones in the last 3 years, have been oversubscribed. Anecdotal evidence, the market is still growing, but one of the issuers told us that their green bond was the first time that they were able to issue a 10-year bond. Previously, all the issuances had lower tenors, and it had the effect of bringing in new types of investors. So what are some of the lessons we've learned over the last few years? Credibility of the market is key, and I think both Rian and Steve alluded to this. The advantage, I think, of coming in now for some of the markets in Africa is that there are relatively well-established and recognized frameworks in place that we can sort of look to build our own markets. But the downside, if I can call it that, is that investors are more critical about what they're funding, and be interested to get perspectives of others. But my sense of this is, for example, even if you're looking at a use of proceeds bonds, investors are starting to look through to the issuer as well. So it's not just good enough that the bond is green, the issuer has to be sort of committed to greenness or sustainability as well. You have to build domestic investor awareness. International investor focus on sustainability is a fantastic thing, but you have to get the local market, domestic fund mobilization moving as well. Particularly we've seen in South Africa in times when international investors pull out, you have to have domestic investors who are able to step in. Otherwise it reduces the attractiveness of the local market. One of the things we had to think quite carefully about was the local ecosystem and who within it could support the growth of this type of market, whether it's preparation of relevant legal documents, provision of second-party opinions, and we found sort of, I think, quite creative ways to get some of that going. And then finally, I think it's important to think about where the financing need is. You know, in South Africa, we started with a green bond framework because it was well known internationally and something that we could reference. But actually for us, social issues remained and still remain incredibly salient in the immediate term. And I'd like to suggest somewhat provocatively, climate change is actually an environmental crisis, but a political one, by which I mean that you have to bring people along with you. So while we know and genuinely accept the necessity of the climate transition and the enormous opportunities that it presents, getting there is not an inevitable choice. You need to convince people of the need to transition. So subsequently, what we've seen is the issuance of combined green and social instruments. And fortunately, our green bond framework that we started with allowed for the issuance of an SDG-linked bond with both climate and social inclusivity components. And we expect certainly in South Africa that we're going to see an increased focus on these combined types of instruments. So let me leave it there.
Great, thank you very much. Turning to the local investors and the assets that they are going to be investing in, I'd like to turn to Hela Chekruhu, who is actively fundraising for an investment vehicle called Nithio that will channel capital to finance renewable energy, specifically pay-as-you-go solar systems, and starting in East and West Africa. Kenya being one of the countries. So this is an innovative frontier financing facility that's investing in innovative solutions for renewable energy that will reach the poor, low-income households. Hela, why is there a need for an intermediary like Nithio? What is the market failure that it's addressing?
Thank you, Anne-Marie. I'm deeply honored to contribute to this excellent discussion, especially given my work for more than 15 years, building from scratch some of the financial infrastructure, the pipes, if you will, that mobilize and channel billions of dollars in climate finance to developing countries, especially in Africa, starting at the African Development Bank, continuing with the United Nations Green Climate Fund, and now at the Nithio platform. So Nithio is, as you well said, a data-driven investment platform. We focus on building what enables universal renewable electrification in Africa. We do so by removing a key bottleneck in the distribution of renewable energy in our countries, including to the base of the pyramid communities, namely a deep understanding of the relative ability to pay by the end users for the energy products and services they receive. As you know, very few energy distributors are profitable in Africa. And the key market failure is the limited ability to forecast and proactively manage the receivables of future energy payments by the end users. This also makes it harder for distributors to raise funding at scale, given that a main asset of theirs, the receivables of those future payments from end users, is difficult to assess and put a dollar value on it, so that it can serve as a base to raise funding that fuels their growth. Indeed, sharp growth in renewables distribution is essential not only for mitigation, but also for adaptation to the impacts of climate change, including on the agrarian economies in our countries. The Nithio platform is using high quality granular geospatial data that is predictive of the ability to pay of the end users, including a combination of socioeconomic and environmental data. And our machine learning algorithms provide reliable forecasts of the cash flows we can expect from the renewable energy receivables. This work is particularly effective when we are targeting rural communities whose ability to pay derives from a combination of climate and environmental factors, such as relative aridity, access to water sources, the nature of the crops, as well as socioeconomic factors. We also observed that this approach is valuable in a COVID environment because our forward-looking modeling was able to derive the likely scenarios of cash flows driven by the impact of the COVID crisis, which is very helpful to ensure the continued financial viability and liquidity of the distributors of renewable energy products and services. Basically, all of this allows Nithio platform to build a pool of standardized end users' future cash flows, which are then funded through limited recourse receivable warehousing facilities, the main financing instrument that is helpful to these distributors. Then in turn, we pull these receivable warehousing facilities into the financial intermediary, Nithio financial intermediary that you mentioned, which mobilizes and channels funding at large scale for renewable energy access in Africa. We use best practice approaches to blended finance by combining catalytic sources of capital, such as FSD Africa Investments, which I salute for their role, with risk capital from large international institutional investors, as it was mentioned that local finance and international finance have to combine to fill the gap in infrastructure finance for coping with climate change in our countries. In the case of Nithyo, we are backed by TPG, which is a top 5 asset manager globally, through its impact fund RISE, which is basically mobilizing savings of workers from US institutional investors such as the Washington State Pension Fund and CalPERS. So in a nutshell, what Nithyo is doing is it's building a robust and reliable pipe, part of that infrastructure for channeling institutional funding that can flow at scale to the renewables distribution for all Africans, including rural and base of the pyramid communities.
Great, thank you, Hella, and I really salute you for this innovation and really for the commitment and drive to producing those results, and we're delighted to be able to work with you on this. I'm going to turn to another fund manager. So Paul is one of the first East African PE fund managers. What challenges are you seeing, Paul, in investing in businesses that are either green themselves or are beginning to incorporate green solutions in their operations, such as solar panels and manufacturing, et cetera? And what policies do you think are needed to encourage businesses to actually go green? Paul.
Thanks very much, Anne-Marie, and again, thanks to the organizers for the invitation. Yeah, look, as a regional private equity fund manager, our mandate is not necessarily just to invest in green sort of qualifying projects. Our mandate is to invest in mid-sized growth companies, but the prism through which we invest is underpinned by impact, social and sustainable impact on these investments and across East Africa. And as a manager, we both recognize the imperative and also are intentional about our impact that we're making on these businesses, specifically around the sort of green energy, clean energy strategies and green finance. Our approach is to achieve this, is to monitor and to measure the impact that we make at the level of a specific portfolio companies, at the project level, the company level. And we do this through a series of tools and with dedicated resources internally, as well as external specialist resources to both look, I guess we're migrating from the traditional role of just looking at sort of ESG, environmental, social, and governance, and to migrating towards looking at impact, both on climate and on the beneficiaries in which the ultimate underlying companies, in the underlying companies in which we invest. We have, and we do monitor and measure this at the portfolio company level. I mean, one of the things that we have been toying with is that, as an industry, the private equity industry, I don't think we've been very good at consolidating the data across the industry because the impact that we're making on climate is sort of probably not visible to the green investors or to social impact investors necessarily. And so our impact and if you aggregate all the data across all the private equity industry players and their impact down the line, I think we should, and if we share that data in a structured way, as an industry, I think we can do much more to promote green finance and to demonstrate the sort of climate mitigation impact that we're having across the industry. Something that would do two things for an industry is one, it would facilitate the mobilization of more capital to have more impact across the market, and also should mobilize our policymakers to be more creative about the incentives that might come towards the industry. And one of the biggest areas that we have impact is really around conversion of our operational businesses, manufacturing concerns with solar energy. That's one of our big areas of impact. And so we have very much focused on that. And policy, particularly in Kenya, has been quite progressive, I would say, in terms of making incentives for the industry of renewable energy. The one thing I might just, because I know we have a few policymakers on the call at the conference, is to sort of highlight a recent amendment to a finance bill where there has been the introduction of VAT on solar equipment that's being imported into the country. Now, this is a result of the COVID pressures on government budgets, but it does have risk of taking a little bit of the, releasing a little bit of the air out of the very rapid adoption that we have seen in this market in respect of migration towards solar energy. The other, I think one of the other speakers spoke to sort of blended finance, innovative solutions, and particularly mobilization of capital in the local markets. Again, I think this is where the policymakers have been quite progressive in that the pension fund industry, we've seen higher and higher allocations of funding towards the pension fund industry, towards the private equity asset class in the last number of years. I think there is an opportunity here again for adopting some frameworks that are already well tried and tested in terms of incentivizing our asset gatherers, our capital gatherers in this region, to be more discerning about investing in businesses or in funds that have got a lens, a prism through which they look at the market from a green energy perspective. I'll leave it there. Anne-Marie?
Great. Thank you very much. I wish we had time for further discussion and further debate. This has really been a rapid fire of perspectives from the different sources of capital and from the investors. I just really want to thank all our speakers for sharing with us their words of wisdom in such a short 5-minute soundbite. But I think there's a lot to digest and a lot to follow up on. And so I just wanted to take this opportunity to thank you all, and I'll hand over to James. Thank you, James.